one is we had inflation numbers. Now the FOMC meets this week, and they're going to determine the federal funds rate, and the expectation is that they're going to move the federal funds rate down by 1/4%. So the federal funds target range right now is between 4 and 4.25%. If they go down 1/4%, it'll be 3.75 to 4%. The concern among a lot of people is that the most recent inflation data that came out, the Consumer Price Index, showed inflation, yearly inflation, so this is for the previous 12 months, yearly inflation as 3%. And this was slightly below what economists expected, and so policymakers were kind of talking that up as a victory, but 3% is still significantly higher than the Fed's target of 2%. So the Wall Street Journal has a great editorial about this. It's called "Getting Used to 3% Inflation," and it sort of highlights the complacency among policymakers in just accepting 3%. And we have to remember, this 3% is coming on the back of the very high single-digit inflation that we experienced 2 years ago. So you saw a huge decline in the purchasing power of people's income and the purchasing power of the dollar, and that's increasingly being the case. As the article points out, 3% inflation may not sound like a lot, but if you accrue that over 10 years, it's a loss in purchasing power on the dollar of over 26%. So it's a significant decline in the value of currency. I guess the real issue is if people start to expect that this is kind of the new norm. I mean, the Fed is cutting interest rates at a time when inflation is still above its target.